this is more of a trend-based prediction, is that the divide between the legacy property managers who have been in the business for a long time and are a little less tech savvy, and the newer property management companies, or I should say, legacy operators, newer operators, that the divide between those two camps will continue to explode. And this has been a real trend that we've seen accelerate in 25, specifically because of AI, but also just because of just what's available from a technology and a process efficiency standpoint to PMs. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. This is the last episode of 2025, and due to it being the last episode of 25 and us heading into 26 here in a few days, I thought it would be interesting to share some predictions that I have for 2026 as it relates to the multifamily real estate market and some trends that I think investors should continue keeping an eye on. And then, in other words, some things that I think are going to really happen in 26, both from a what's going on in the market standpoint, but also just what's going on within the multifamily industry standpoint. And for a small subset of the listener base, this may be a little repetitive as I sent out a very lengthy email to our email newsletter, or to our newsletter list, I should say, running through all of these, but I wanted to run through them in a longer form fashion as well. And as an aside, if you're a listener who is not subscribed to our email newsletter, I highly recommend you do so. We send out a significant amount of valuable, tactical and valuable content to our audience on that platform, both active investors and passive investors in terms of who's subscribed to it. So we'll include a link in the show notes for that. Be sure to sign up if you haven't signed up already. But nevertheless, let's get into the 8 trends and predictions that I have for 2026 as it relates to multifamily real estate. Number one is that real estate will only continue to become a significantly more politicized asset class. It already is a highly politicized asset class from an investment standpoint, but a prediction that I have heading into next year is that this trend will only continue to really accelerate, frankly speaking. And there's some key events that have happened over the last few months that really speak to this, right? One of the big ones is mayors like Mamdani winning elections who are running on platforms that are based around rent control or rent freezes or, really just at a higher level from an economic level, just focused on freezing pricing or just other, whether it's housing or outside of housing, and really just focused on reducing costs of living. There's a whole other conversation around what the right approach is to doing so that I'm not going to have right now. I'm just going to speak to it as it relates to real estate. But at the end of the day, as time passes, real estate will only become more politicized, right? It's never really going to go the other way. Like there's never going to be a period of time where legislation starts to significantly repeal or minimize or lessen around the operation of multifamily real estate. So, that, and then, for example, Massachusetts is introducing statewide rent control on the ballot in late 26, and it's very prohibitive rent control. To make a long story short, from a prediction standpoint, I think investors are going to become as concerned with the political landscape, landlord-tenant laws, et cetera, in markets when deciding where to invest capital as they are the other traditional metrics that investors use to evaluate markets, such as job growth, population growth, median rents, all of that, all those different stuff, all that stuff, right? Insurance costs, all that. And while in the past, the actual political atmosphere has been less essential, very broadly speaking, outside of the really crazy markets like LA, New York City, San Francisco, some of the, these legacy, highly politicized markets from an operations standpoint as it relates to real estate. But even outside of that, when you're taking the Northeast or the Northwest and you're broadly categorizing areas that have somewhat more thorough landlord-tenant laws, yes, it's been a consideration for many investors, but really the driving decision, the driving data behind making decisions are still the legacy, like population growth, job growth, cap rate compression, stuff like that, right? That's actually a little bit more in tune with the operations of the property itself and then of the capital markets around the property. Whereas I think heading into 26, I think this trend will significantly accelerated, much more so than it did in 25, but will only continue to accelerate in the future. Number two, prediction number two, C class valuations will struggle to rebound. And this has been a trend that has permeated over the last few years, specifically in the high supply markets like Southeast and Southwest, Texas, Arizona, Sunbelt, et cetera. It's been less of a dynamic in lower, lesser supplied markets like the Northeast, Northwest, et cetera, Midwest. But broadly speaking, what I'm talking about here is I think C-class valuations will struggle to rebound because the actual creditworthiness of the residents living in these buildings is going to continue to decline and struggle, right? I think the typical C-class resident is only going to continue getting squeezed by cost of living increases and inflation and, a toughening job market heading into 26. And the very simple translation here is that they won't be able to absorb the standard 2, 3, 4, 5% rent increases that have become the norm over the last 12, 13, 14 years. And I think this is a little bit more prevalent in the Northeast right now, this particular prediction as it relates to heading into 26 than many other markets, because the listeners who are listening to this that have been investing in Texas or Florida or Arizona, where there's been all kinds of new supply, they're like, dude, obviously, right? This has been something we've been dealing with for multiple years now. However, I think as supply has been absorbed in the Northeast, and we've now settled into a period of time where supply is being absorbed, and now we're just looking at the fundamental operations. We're still seeing this dynamic permeate, and this is a prediction that internally we have going into 26 that's really driving our decision making, where we're oftentimes underwriting gain to lease, right? Where the existing leases at a property right now may be higher than what the market would be if those tenants were to move out, right? Which is not something we've ever had to do specific to, call it, New England. And I think downstream, all of this results in C-class apartments, again, being less attractive to investors. They are a little less reliable from a return standpoint because the credit or the creditworthy of the tenant base is less. Lenders are going to be less enthusiastic about lending on C-class deals. And if you're holding a C-class deal right now, you're probably going to have a narrower buyer pool, to exit to, which means that cap rates aren't going to compress for these buildings in 26. Number three is that light value add deals are going to become even more attractive than they are right now. Alternatively, heavy value add deals that require significant construction, or what I think is more specifically the challenge nowadays, significant overhauls from a management approach, like some type of significant retenanting or repositioning from a management standpoint that requires you to access a large number of the units at the property, are going to become much harder to execute. And I think the reason that I bring up the management piece of it is it ties into number one, right? As the very broadly speaking, the political landscape becomes heightened and legislation continues to increase around operators' ability to operate multifamily properties, it becomes much harder to execute a really hefty value add where you got to work through a number of the units. And that introduces just risk, right? It's harder to underwrite your vacancy. It's harder to underwrite your bad debt. It's harder to underwrite, your cash for keys, if that's part of your underwriting. So there's that component. And then also there's the construction piece, right? Which is it's harder to accept the risk of spending significant amounts of dollars from a construction standpoint, 20, 30, grand a unit plus common area spending, for example, if you aren't as comfortable underwriting the stabilized rents. And if you think that rents are going to continue to flatten or decline while you're working through the project, which again is a dynamic that I think investors should be wary of, especially in the C-class sector. So, in my opinion, I think that people are going to much more heavily pursue light value add, where the business plan is let's do the common areas, we're going to do some of the exteriors. When the units organically vacate, we'll spend some money, 5, 10 a unit, something like that. We get some minor rent bumps. We may be doing paint flooring. Maybe we paint some cabinets, but that's really the extent of the turn. And where you can underwrite to a little bit more of a margin of safety. And again, as the market becomes a little bit harder to predict, and it's a little scarier to get into these projects because you have to execute on budget on time because there's really little margin for error because the market's not helping anybody. I think that's going to become a dynamic, is that multifamily investors will start more heavily pursuing the light value add deals. Prediction number 4, and this is more of a trend-based prediction, is that the divide between the legacy property managers who have been in the business for a long time and are a little less tech savvy, and the newer property management companies, or I should say, legacy operators, newer operators, that the divide between those two camps will continue to explode. And this has been a real trend that we've seen accelerate in 25, specifically because of AI, but also just because of just what's available from a technology and a process efficiency standpoint to PMs. And this includes, yes, a lot of AI tools such as conversational AI to assist with top of funnel leasing, smart maintenance AI that can triage maintenance requests and address incoming maintenance requests, try to help some folks kind of solve maintenance requests on their own with some follow-up questions, with some queuing up how-to videos, etc. There's obviously all of the implementations that AI can have around looking at data and interpreting data from an asset management standpoint. And the legacy PMs that are not embracing these tools or embracing the use of these tools are really just going to get left behind, and their market share is going to get completely chewed up because they're not going to be able to compete on pricing because the newer PMs that are really adopting these tools are running much more lean and efficient businesses and therefore price their services according to the services that are according to just the cost profile of their business, which means they obviously absorb more business in the marketplace. And I think a very significant corollary to this, kind of a clear one-to-one example of this was the massive shift to adopt global talent in the mid 2010s and into the late 2010s. And still now, I mean, it's still, I mean, there's a lot of legacy PMs that aren't adopting it now, and they're going to get left in the, behind if they don't. But, when all the PMs started to supplement their in-office staff with global talent who could assist with operations but didn't need to be in the office, such as leasing assistants, such as property management assistants, such as bookkeeping, such as marketing, like all of these different roles that don't require you to go and walk into an apartment, which is a lot of the workload of a PM. When a lot of that started heading offshore at a fraction of the cost profile started to tighten up, and that efficiency passed down to owners. And a lot of the legacy PMs that are like, I need to hire my 70K a year bookkeeper that sits in the office, they just can't compete really anymore. And a lot of those folks have adopted global talent. They did so late and they were kind of behind the eight ball. But the same thing is happening with like all the AI tools and then all of just the software tools, even outside of anything with AI implementation, that help to optimize the process of property management. And I think that divide is going to continue to just significantly magnify here in 2026. Prediction number 5 is that the market will continue to trade more efficiently for smaller assets. I think efficiently, just broadly speaking, but really significantly more so for smaller assets, which I'll describe as, 2 to 20, 2 to 30 unit deals. And I think there's two reasons, two main reasons for this. Data is so abundant now, right? There's just so many research tools, whether it's finding rent comps, sales comps, whether it's evaluating lenders against each other, whether it's just analyzing the return on construction spend. Like the informational edge that experienced local longtime investors once had as it relates to looking at their own portfolio and pulling all of the data from that in conjunction with the limited tools that were available to the broader market, like that competitive advantage is shrinking quickly because of just how much data is now available and how easy it is to access that data and to interpret that data. And as a result, like a new investor has a lot of information to make an educated decision. And I think that will only continue to ensure that the market trades more efficiently. And that's, those significant outlier deals where something sells at a crazy high price or a crazy low price and gets away from the median, like those crazy outlier deals will continue to disappear and deals are going to trade in a tighter spread. Above and beyond that, I think the real estate investing education space has grown like to the point to where it is almost impossible to be like a bad real estate investor. Bigger pockets, YouTube, podcasts, books, social media, shows like mine. Like it's really hard to just be somebody who goes out there and buys a 3-unit deal to go be a real estate investor and to not have literally everything you need to be good at it. Like it literally just takes any amount of effort to have all of the answers to your questions. And then above and beyond that, again, tying into number 4 with a lot of the tools that are available, like you can get a free property management software that if you're self-managing, gets you to 20 units, does your bookkeeping, does your leasing, processes your rental apps, gives your tenants a portal. And it's it's so hard to be bad at this now. And I think, again, that in conjunction with all of the data that's available means the average real estate investor is better and they have more data. So more deals are going to trade in a tight window, I should say. Prediction number six is that price is going to start beating amenities in B and C class assets, and price is going to be the best amenity, right? And I think last year we started to see it, we started to see this really develop where investors started abandoning, more of the fancy amenities playbook, or I should say spending money on what, the nice to haves when doing a value add, right? Co-working spaces, fitness spaces, clubhouses, pools, higher end finishes within units because they weren't getting the commensurate rent increases required to spend the money and take the risk in doing all that work. So what I'm predicting that we're going to start seeing now is that investors are going to realize that reducing capex and offering more competitive rents is a better strategy right now. And for example, what this could look like is where we go out there and we're doing, a premium laminate in our unit instead of granite. We're doing the white appliances again, or the black appliances versus stainless. Maybe we're painting our common areas and doing a less expensive flooring than doing like paint, fixtures, a nicer flooring, railings, etc. Like we're trying to reduce the scope of our capex just a little bit so that instead of needing to get $1,800 for our two-bedroom apartment, we can list it for 1,725, 1,750. And what we're finding is like the demand is just going to be centered around price for a while here, specifically in C class. This is very much true in C class. So this is a change that we're making in our business as it relates to the scope of work that we're doing in our units. Number seven, and I think this is just again a fair one. I think I'm not breaking any news here, but the home ownership gap will continue to significantly widen. And single family home prices just continue to separate from what buyers can actually afford. And this is really true in the supply constrained areas like New England. And the first time, the age of first time home buyers keeps increasing. People are renting for longer. And I think we're all aware of that dynamic. But as it relates to the operations of multifamily real estate, I think that we're just seeing more families stay in apartments for longer and stay in apartments as their family continues to grow. So, for example, the length of stay for 2 and 3 bedroom units, I think will continue to one be much longer than one bedrooms, but I think that gap will continue to widen, right? Where it's been it's known in the industry that folks who live in studios and one beds move out faster than folks who live in twos and threes because you just have more families in twos and threes than in ones, obviously. So and this is just broadly speaking, on average, maybe you get 18 months to 2 years out of a typical studio one bedroom resident, but you get 2 to 3 out of a two or three. But I think that gap's going to continue to widen where because it's so hard to buy a house right now for the average American family, a lot of these folks may have their first kid in an apartment and then have their second in an apartment and actually, really rent for a true longer period of time to where they go from a 2 bedroom to a 3 bedroom once they have two kids. And for those who are living in threes with already two kids, like their length of stay is going to continue to become much longer. And I think that means we're going to see more demand for units with 2 and 3 bedroom units than studios and ones. Number eight, and this is the last one, multifamily valuations will just stay flat. There was all of that talk back in 2022 to 2025 about, survive till 25, right? When interest rates started to increase in early 2022, mid 2022, I think that was right around the time frame where rates started to run. Everyone at that time and then throughout 2023 was like, just survive till 25. The market's going to rebound. The Fed's going to cut rates. We're going to see just rents themselves rebound. And there was all this optimism about just get to 25 and things are going to get better. And here we are heading into 26 and things have not gotten better, right? Very broadly speaking. And yeah, there's some data that looks good. Okay, we're not going to have as much supply going online in 26, which means like rents should rebound a little bit. But at the same time, broadly speaking, economically, we're not seeing the economy improve specific to B and C class that's going to give residents the ability to pay more rent, right? So demand itself is going, I don't think demand's going to increase significantly personally, just based on what we see in our own portfolio. And as a result of all that, even if we get another couple of rent cuts, like I don't really see multifamily valuations, just increasing. Like I don't see cap rates compressing personally. And, at the end of the day, any rent growth we see in 26, I think is going to be offset by a lack of demand or commensurate expense growth. The lack or the degradation of tenant creditworthiness, it's specific to Class C, really specific to Class C, but also somewhat in Class B, is going to, to make it so lenders are less enthusiastic about lending to Class C. Investors are going to be less enthusiastic about investing in Class C. So even if we see rents come down, or excuse me, not rents, but rates come down, we're probably going to see lender spreads maybe increase because again, in the asset class, it's harder to evaluate from an operational standpoint. And even if NOI stays flat as a result of this, or even if it grows a little bit, if the debt markets don't necessarily cooperate, well, then cap rates aren't going to compress, right? So I don't think that anybody who's got a property they bought the last few years who have been holding on, hoping for some appreciation of value or some compression in cap rate or some rate cut that's going to bail them out in 26 is going to really be happy with the decision that they've held throughout this year. I think in 27, that's probably when we start to see, some more normalization within the marketplace. But again, that's way out, and I don't even feel comfortable making that prediction. But I think just in the short term, next 12 months, your property is not going to trade at a lower cap rate than it is today. I just don't believe that. So hopefully you all found this episode insightful, and hopefully you pulled something out of this episode that maybe changes how you view the business heading into 26, or maybe some of the decisions that you're making as you continue investing throughout 2026. And if you enjoyed this episode, please leave the show a rating and review. And if you really want to be a great listener, if you really want to earn my appreciation here, feel free to shoot this episode out to somebody in your network. Text it, email it, and if you really want to go nuts, throw it on social. That's how the show grows. It's how we get more folks here listening to the podcast, and I appreciate everybody who's ever shared it in the past. But thanks again for everyone who has listened throughout 2025. It's been a great year producing and releasing these episodes, and I look forward to releasing more in 2026.